Swayam Prabha. Digital India. Educated India.
Hello, Namaste. I am Dr. Diksha Munjal Shankar. I teach as an Assistant Professor of Law at the Faculty of Law, University of Delhi. So now we will be moving forward with our 9th lecture, which is on income from other sources. So income from other sources are dealt with between section 56 to 59. And while we explore this head, we will be looking at these topics in detail. The first one being how is it that it constitutes a residuary head. Next is section 56, 57, which talks about deductions, and 58, amounts which are not allowed as deductions. So up until now we have discussed different heads of income. So we started out with our first head, which was salary, followed by income from house property, then profits and gains from business and profession. Then we looked at capital gains, and now we will be looking at income from other sources. So whenever we have any income at hand, we first need to start checking sequence-wise where is it that a particular income falls, right? So when we had started discussing salary, we checked certain parameters and found out that, well, if it does not fulfill the criteria of salary as has been provided under the Act, we move to the next section, which is house property. If it does not fulfill that, then we move to the next one, which is PGBP, followed by capital gains. Now, let's say, for example, there is some sort of an income which has not fallen under any of the previous 4 heads. So it has not been able to satisfy any of the heads, the requirements of any of the heads of income. And in addition to that, it is not even exempt under section 10, right? So when we are looking at the heads of income, or when, let's say, we are looking at a particular income, right? If it is not falling under the head salary, house property, PGBP, capital gains, it's not falling under that. And in addition to that, it is not even qualifying for anything under section 10, right? So section 10 is talking about what? Section 10 is talking about exemptions. And if a particular income is not falling under any of the exemptions, is not falling under any of the heads, then we will pick up that income and put it under this residuary head of income from other sources. So by residuary head, we mean that anything that does not fit and fulfill the conditions of any of the 4 heads, we will nicely put it in under this particular head of income from other sources. Now, let's say, for example, you are getting salary as a director. But when we are talking about your salary as a director, we are looking at a situation where there is no employer-employee relationship, right? So if there was an employer-employee relationship, if it was there, then it would go under the head salary. But if there is no employer-employee relationship, then it will go under the head income from other sources. Also, if you go back and you recollect the case of G.R. Karthikeyan, which we had discussed as the first case under our first lecture, right? So in G.R. Karthikeyan's case, again, when we were talking about whether the winning amount from the motor rally, whether that would constitute income or not, right? So over there, we pick up a motor rallying case and then we say, can we put it into the head of salary? Is there an employer-employee relationship? No. Then we look at the next head, which is house property. Does it fulfill the criteria of house property? Clearly not. PGBP? Maybe. Or does it fulfill the criteria of capital gains? Clearly not. Or it could possibly be income from other sources, right? So when we are looking at the case of GR Karthikeyan, we could either have that income fall under the head PGBP, or we could have it fall under the head income from other sources, right? So it really depends on the facts and circumstances of the case. Where is it that a particular income will fall, right? So if we were to understand this particular income which had come into the hands of GR Karthikeyan, we would have to understand whether this was actually his business or profession. If it was really his business or profession and he was getting the money on a regular basis as a result of that business or profession that he was running, then it could fall under PGBP. If not, if it's a one-off thing, then it will clearly fall under the head income from other sources. But the thing remains that everything that is there within the Act that gets covered, or whatever income we have which is there under the Act, and it is not falling under section 10, will necessarily fall into one of these heads, right? So it will either fall into salary, house property, PGBP, capital gains, or IUS. So whatever income is there, we pick it up, we check it against the heads. If it's not falling under any of the four heads, not something that's getting an exemption under section 10, we then place it under this residuary head of income from other sources. So section 56 enlists some of these. For example, you've got interest on bank deposit, right? So we all have savings bank accounts, right? So when you deposit some money in the bank, obviously there's going to be interest that will accrue on that, some interest that will arise out of that. Now what happens to that interest? Does that interest go tax-free? No. That interest goes and gets taxed under this head of income from other sources, because it's clearly not your salary, it's not income from house property, PGBP, capital gain, none of them, right? And when that is the case, we pick it up and put it under the head income from other sources. Then you've got interest on investment. Then you've got salary to MPs or MLAs given by the Government of India. So if you look at the salary which is given to MPs and MLAs, we are talking about salary over here, and then we are talking about income from other sources, right? So what do we look at when we have to use this term salary in the context of taxation? We have to look whether or not there is an employer-employee relationship, right? But in case of MPs and MLAs, there is no employer-employee relationship that they have with the Government of India, right? And therefore, while we loosely call it salary, it does not necessarily fit into the criteria of salary as has been provided under the Act. And which is why this particular income which falls into the hands of MPs and MLAs from the Government of India, that will fall under the head income from other sources. Then we have salary to a director. So just as we had discussed in the case of Ram Prasad, over there we had seen that the director was to be considered as an employee of the company. Reason being that there was an employer-employee relationship. There was a very strong control that the employer maintained on the employee. Why? Because there was a contract of service. But when there is a contract for service, then we will talk about this head income from other sources, right? So which is why it is said that it is really dependent on the terms of employment. If your terms of employment are such wherein there is hardly any control, there is no contract of service, but rather it is a contract for service, over there, whatever income comes into the hands of the director as loosely what we call as salary, that income will get taxed under the head income from other sources. So coming back to the point of interest on bank deposits. So let's say, for example, you have created some sort of an RD account, which is nothing but your recurring deposit, right? So you are going to receive, you are going to put in a principal amount every time, right? You keep accumulating that amount, and because you have accumulated the amount that was required from the bank, you are going to be paid some amount of interest on that, right? Now, when you receive that interest would be subject to nothing but income from other sources. It will be subject to tax under the head income from other sources. Similarly, if we look at our normal savings bank account. Now, normal savings bank account, what is happening? We are putting in some amount at some point of time. This may be regular, this may not be regular, right? So, some of us have accounts which, let's say for example, I've got two accounts. One wherein, let's say, my salary is credited every month, okay? And the other one which I just, transfer my amount from one bank account to the other. So, the other one I'm using, let's say, for just purely dealing with my household expenses, maybe to keep a better track of what is happening. So, in that case, I am receiving my interest on both the bank accounts. So, I've got bank account 1 and then I've got bank account 2. So, bank account 1, I am getting some interest, right? And on bank account 2, I am getting some interest, and so on and so forth. So, if I'm getting an interest amount in my hands, that interest amount from whatever kind of bank deposits I have, that will be subject to tax under this head income from other sources, right? Now, if you contrast this with a situation wherein, let's say for example, I am a bank account holder and I am holder number 1, okay? And then I also have holder number 2, H2, who is my minor child, okay? I could also reverse the situation, make minor child holder number 1 and I could become holder number 2. Now, if my minor child is holder number 1 and I am holder number 2, who is getting that amount? The amount is coming in the hands of or in the name of the minor child, okay? And the interest that is getting accumulated is also getting into the hands of the minor child. But am I supposed to be liable to pay tax on it, or is it the minor child who's liable to pay tax on it? So, at this point of time, we will be looking at a concept of clubbing of income, right? So, we will deal with clubbing of income in the next lecture, but for now, just to give you a heads up, whenever there is a minor child involved, and because you cannot put a minor child at a loss according to the Indian Contract Act, therefore, the person with whom the account is held, right? So, if I am holder number 2, then I am liable to pay tax on that interest that is coming into that bank account, okay? So, when we talk about interest on bank deposits, this can be in different ways depending on what kind of accounts we hold, with whom do we hold these accounts, right? So, whatever interest is coming, whether you are keeping it as a part of your savings bank account, whether you're getting this interest on your RD account, whether or not you're holding this particular account with a minor child or not, irrespective, whatever interest comes into your hand as a result of that bank deposit, that will be subject to tax under the head income from other sources. Similarly, if you're getting some interest on investments, right? So, that would also be subject to tax under income from other sources. Then, we have subtenancy made by tenant. So, let's say for example, you have a house which you are letting it out, right? So, you are the owner O and you let it out to the tenant T, and the tenant T sublets it, alright? So, that means the tenant gives the place out on rent to another tenant, right? And then the original tenant owns out of that property. So, let's say T1 gives out the same place on rent to T2. Now, when T1 has given the place on rent to T2, T2 will obviously pay some money, right? So this money which is falling into the hands of T1 from T2, this amount is nothing but income from other source for T1. And now when T1 pays the owner some amount, that amount in the hands of the owner is nothing but income from house property. So if you recall, even when we were discussing the head income from house property, we had looked at this example, right? And we had seen how is it that the concept of deemed ownership comes in, and how the concept of ownership changes how you receive an income, right? And whether or not, depending on your status of ownership, whether an income can be considered as one which is falling under the head income from house property, and if not, then possibly it will fall under the head of income from other sources, right? So for a particular amount to fall under this head house property, the person who's receiving the amount has to be the owner of that property. If you're not the owner, right, and let's say for example you're the tenant over here and you're receiving an amount courtesy the subtenancy, then that amount itself becomes income from other source. Why? Because you are not the owner. Next, we have interest on compensation. So for example, the government acquires some land, right? So let's say the government acquired Mr. X's land and gave him some compensation together with the interest. Now, if you are getting some amount, right, courtesy the acquisition, you are getting that compensatory amount, and along with that compensatory amount, you are also getting interest. So this compensation that you are getting, that is nothing but capital gain. So if you recall in the previous lecture, we had discussed that when does capital gain arise, or let's say that, when is it that a transfer has taken place? So transfer has taken place even when there is compulsory acquisition of property of the assessee and the government pays him for that, right? So when there is that acquisition of property, you are going to get that amount. But let's say for example, that amount is coming to you with some amount of interest attached to that, right? So when you're getting this amount in your hand, this amount will be treated under the head capital gain, and this interest that you're getting on this particular amount, that will get taxed under the head income from other sources. Then we've got family pension. So when pension is paid to an employee, we know for a fact that it will be considered as salary. So again, I request you to go back and listen about how and when do you receive something known as salary in your hands, right? So just to recap, the moment anything flows from the hands of the employer into the hands of the employee, provided there is a contract of service, meaning thereby that there is an employer-employee relationship, at that point of time it will be considered as salary, right? So let's say for example, this person Mr. X is there and Mr. X was the employee. Now during his lifetime, he is receiving the pension, and that would be considered as salary in the hands of Mr. X, right? But now once he passes away, the pension will go into the hands of the family members. And when it gets into the hands of family members, can we call it salary at that point of time? We can't. Why? Because there is no employer-employee relationship between the family members and the amount that is coming into their hands, right? So at that point of time, the very same amount becomes income from other sources in the hands of those family members. Next are any winnings that you have from lottery, gambling, etc. Then we have winnings from horse race, but it does not include camel races. Then we have income from owning and maintenance of racehorses. So horses can be owned, they can be reared, they can be taken care of, provided with food, water, shelter, everything, right? And when you are taking care of these horses, you are sending them out for races, and let's say for example your horse actually wins the race, right? So when the horse wins the race, you will also get a share in the money, the prize money that comes through. So that stake, if that stake is greater than your maintenance cost of the horses, then whatever income comes into your hand, that will be treated as income from other sources, right? So let's say for example, you've got 5 lakh rupees as the stake money, right? And you have spent 2 lakh rupees on maintaining those horses. And the resultant difference which is there of 3 lakh rupees, that amount of 3 lakh rupees will get taxed under the head income from other sources. Then we have got gift. So when we talk about gift, gift is something that all of us receive, right? Right from the time when we are children to adults, all through and through. So when we receive gift, gift is something that we will receive either in the form of cash or some sort of movable property, or if you're lucky, you will also probably get some immovable property, right? So when we talk about gift in the cash component, we differentiate it slightly from other movable property. Technically, cash is also movable property only, but for the purposes of taxation, we make a very slight distinction, right? So whatever gift you receive, technically all of it is taxable, right? So when we talk about cash, and if you are an individual receiving cash up to rupees 50,000 in the entire year, right? So it's your birthday, somebody gives you cash money. It's your anniversary, somebody gives you cash money. You've gone to some place, somebody gifts you again some cash money, and put every amount together. Now, once you see the aggregate amount and that aggregate amount is less than 50,000, then all of it is exempt. But the moment it crosses 50,000 by even 1 rupee, then we say that it is all taxable altogether, right? So if an individual receives a gift up to rupees 50,000 in cash, in the whole year it is exempt. It is the aggregate amount that we look at. However, when it crosses the threshold of 50,000 by even 1 rupee, then the total amount becomes taxable. Then the next thing we look at is movable property. So movable property can also be given out as gift, right? So let's say for example, you received an expensive watch from somebody, right? It was your birthday and you received a very expensive watch. Now, it's not that we cannot quantify the value of that particular gift. We can obviously quantify it in terms of money, right? We can always have the valuation done of that particular gift that you have received, right? So when you receive movable property as gift, we can have it, quantified in terms of its valuation, and then find out whether or not you are liable to pay tax on it. So let's look at this. So when there is movable property which you have received with no consideration, okay, that means you have not paid anything for it. It's a gift, I know, and it sounds quite strange that I might have to pay for a particular gift, but well, you can possibly pay, right? So for movable property with no consideration involved, so let's say for example, you have received 5 articles, article 1, 2, 3, 4, 5. Again, you put all of them together. We pick up the aggregate amount. And if that aggregate amount again exceeds 50,000, then it is all taxable, right? And then you have this provision wherein we talk about movable property with inadequate consideration. So the first thing was no consideration, and over here we are saying inadequate consideration. So let's say for example, you have that watch, right? So your watch is, let's say, worth rupees 40,000. Okay, and that is the only movable property that you have received as gift, right? You've received nothing else in the year. So can we say that you are liable to pay tax on it? No. Why? Because the value of the watch is lesser than 50,000. Okay. Now let's say, for example, this watch is for 1,40,000. Are you liable to pay tax on it? Yes. And why do you have to do that? Because it is exceeding this value of 50,000. So on how much do you have to pay tax? On the difference between 1,40,000 and 50,000? No. You have to pay tax on the entire amount, right? Now let's say, for example, somebody gifts you this watch and you want to save yourself the trouble of paying tax on it. So you say, okay, fine, what I'll do is, let me pay you rupees 1 lakh. Okay, so the person who's giving that gift to you, you say that no problem, what I'll do is, I want to save myself some tax, so let me pay you 1 lakh rupees, and then my gift value is only 40,000, right? So there is inadequate consideration. I have given, but not complete amount, right? So let's look at how that is to be assessed. So even in cases where articles are sold to someone with inadequate consideration, tax may be imposed. So what do? For that, we find out the fair market value. Let's say, for example, the fair market value of a particular article is 2 lakh rupees. Then we check how much did you actually pay for it, right? So let's say, for example, you have paid 1.2 lakh for it. And now the value of the gift value stands at 80,000. So when the gift value exceeds the threshold of 50,000, then the total amount 80,000 will be subject to tax. Now over here, what is our gift value? In the case of the watch, our gift value is 40,000. So are we liable to pay tax over here? No. Why? Because we have not exceeded the threshold of 50,000. Next, we look at the case of immovable property. So if you're lucky enough and you're blessed, you are going to receive some sort of immovable property as gift. Now in case of immovable property, we do not take the gift value in aggregate. In such cases, we carry out separate individual calculations. So what was happening in movable property? We were putting it all together and finding out whether the amount is exceeding, or the value of something is exceeding 50,000 or not. So we put it all together. But over here, in case of immovable property, we don't do that. We treat each of these not articles, but each of these properties as separate ones. So we carry out the calculation on every separate property. So in such cases, we carry out separate and individual calculations. Now these gifts that come into your hands, they could either be without consideration or with inadequate consideration, right? So section 50C of the Income Tax Act provides that the stamp valuation authority is applicable on land, building, or both. So when we look at it from the point of view of without consideration, we do not look at the fair market value of the property. Instead, we look at the assessed value which has been given by the stamp valuation authority, right? So which is why there was a reference made to the stamp valuation authority. So what are we looking at? We are looking at the value which is given by stamp valuation authority. We are not checking what is the fair market value. Fair market value could be higher or lower, whatever, right? But we fix our criteria at stamp valuation authority, whatever it says. So the day a person, Mr. X, receives the gift without consideration of, let's say, land, building, or both, we will look at the value that has been fixed by the stamp valuation authority on that day on the individual asset, right? So if the land and building, the valuation of that is at rupees 40,000, then you're not liable to pay anything. If it is at 50,000, again, you're not liable to pay anything. But if Mr. X paid rupees 1.2 lakh for rupees 1.5 lakh worth of property, then since the gift value is 30,000, it will not be taxed, right? So it really depends again on what is the value of the property which has been fixed by the stamp valuation authority. Then if you receive gift from the following people or on the following occasions, then the entire amount is exempt. One is in case of relatives. So over here, there is a very definite criteria that is provided, and it's not that you will get into very remote relatives also. Okay. Next is at the time of wedding, whatever an individual receives is exempt, irrespective of the amount. Next is when you receive some gift under either a will or by way of inheritance. Next is in contemplation of death by the payee or the donor, as the case may be, right? So we know of this term donatio mortis causa. That means you are in a situation where there is this imminent feeling that you have that you are going to no longer survive. And as a result of that, you want to give out some gifts, okay? And in contemplation of your death, if you give out some gifts and the other person receives it, then because the other person has received it because of donatio mortis causa, that means you have given out that in contemplation of your death, that amount stands exempted in the hands of the person who has received the amount. Next, we have amount from local authority without consideration. So let's say, for example, your local authority has given some gift or prize, etc. All of that is exempted. Then we have an amount which is coming through from a non-profit institution, a registered society, a registered charitable fund, etc. Right? So all of these which have been recognized under the Act, which are registered under the Act, they will, whatever amount flows from them into the hands of the receiver, that amount is exempt. So coming to the definition of relatives. So over here, we first look at relatives from our own closest set of people, right? So the people with whom we are related by blood. So let's say, for example, you start out with mother, father, brother, sister, okay? And then you've got your son and daughter, and then you have the spouse, okay? So when we talk about mother, we also look at people from the mother's side, okay? So if you receive anything from the mother's brother and the mother's brother's spouse, okay? So this is one set of people put together. So that means you're receiving from your maternal uncle, okay, and his wife, or you're receiving from your maternal aunt and her husband, okay. So mother, sister and spouse. Next we have father, and similarly we have father's brother and spouse and father's sister and spouse, and all lineal ascendants as well, okay. Then you have brother and his spouse, you've got sister and her spouse, son and his spouse, daughter and her spouse, then your own spouse. Then we look at it, so the way we have treated the mother, the father, the brother, the sister, same way we pick up that entire chain and we put it and transpose that from the point of view of the spouse now. So whatever you're receiving from the spouse's mother, right? So your mother-in-law or your father-in-law, right? So spouse's mother, spouse's father. And then the spouse's mother's brother and spouse, the spouse's mother's sister and her spouse, okay? So similarly, we pick it up and we'll pick up the similar criteria and then see it from the point of view of the spouse. All of that gets covered as well. And finally, you've got all lineal descendants. So that means your son, your son's son, 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 okay. So whatever descendants that you're looking at, we're taking into account all of them. So when we talk about movable property as gift, we say that all of this gets included. So we are talking about bullion. That means any coin, any biscuit, any bar that is made out of those precious metals, right? So gold, silver, platinum, all of that. That is also considered as bullion. And then we have jewelry, which is ornamental jewelry that we're referring to over here. So when we talk about movable property as gifts and we are saying that all of these are to be included as gifts, we saw that technically when you see all of these articles that have been listed over here, we see them as nothing but capital assets, right? So if we saw a bullion or we saw jewelry, whether ornamental, non-ornamental, or we looked at sculptures, or we looked at some sort of artwork, drawing, painting. So let's say, for example, you receive some sort of painting that is made by a very, very famous artist, right? So if you're receiving that painting which has been made by a very famous artist, technically it will be seen as a capital asset, right? Will probably attract capital gain. But if you are receiving this gift of a painting of a very, very famous of a very famous artist, then at that point of time, given the fact that you're receiving this gift, and let's say you're receiving this gift at the time of your wedding, right? So if you go back and you see at the time, right, whatever an individual receives is exempt irrespective of the amount. So over here, let's say for example, you're receiving that painting as a gift at the time of your wedding, that would also be then exempt, right? If you are receiving some sort of gold coin, right? Let's say somebody gifted you a 1 gram gold coin or a 5 gram gold coin or whatever, right? Because you are receiving it at the time of your wedding, that would be then excluded, okay? So when we're talking about receiving gifts at the time of wedding, we only mean wedding. We do not take into account any other occasion which is attached with the wedding. So let's say for example, you receive something on your first anniversary, that doesn't count, right? Then we talk about sculptures, artwork, drawing, painting, archaeological collection. All of these would be considered as gifts. So apart from gifts, so we got a little lost in gifts over here, right? So gift was one, and before this we were looking at the different components, right, which would constitute as income from other sources. So one of the sources of income from other source would be gift. And then again, going forward from the gift, we say that if you are getting some sort of remuneration because you as a teacher have either set a paper or you have evaluated answer scripts or you have carried out some invigilation duties, all of those payments which come into the hands of the teachers, that would be considered as income from other sources. Then we have composite rent. Now, if you understand rent, we understand rent from the perspective of a particular house property being let out, right? Now, let's say for example, this is your house property, okay? Let's call it HP1, right? If you simply let out this building, okay, the income that comes into your hand will be taxed under the head income from house property. Why? Because you have simply let out the building. Then we look at another house property, we call it house property 2, right? And over there, there is some plant and machinery which is already fixed over there, right? So this is plant and machinery. Now you have a choice. If you can possibly separate the two, if you can separate your house property from the plant and machinery which is there in those premises, if you can separate the two and then get an income, then in that case, the income that you're getting because you're letting out your plant and machinery could either fall under the head PGBP or it could fall under the head income from other sources, right? Depending on the facts and circumstances. and income from this letting out of the house property, that will fall under the head income from house property. But if you are in a house property like this, HP3, wherein the plant and machinery is so intrinsically linked with the building that you cannot separate the two. There is no chance that you can give out your plant and machinery separately from your house property. So it's very, very intrinsically linked. You cannot separate the two. You cannot say that, okay, fine, I can give my plant and machinery on rent and I can give out my house property on rent in a different or to a different person or in a different manner, right? So when we are looking at it from this perspective where everything is so intrinsically linked, at that point of time, you are giving out the entire premises including plant and machinery on rent. And what you are getting in your hand is nothing but composite rent. Okay. And when we talk about composite rent, that is subject to tax under the head income from other sources. So house property together with plant and machinery, when it cannot be separated and given out on rent separately, we are looking at that sort of an instance. So either income will go under the head house property or income from other sources. But in case of house property, as we discussed here, it is only on the building, nothing more. And here it will therefore go under the head income from other sources. Why? Because you are not able to detach the two, right? You're not able to give out your plant and machinery on rent separately from the building. And so now what you're getting is a composite rent, rent of building and plant and machinery put together. Next, we look at Keyman insurance policy. So in case of Keyman insurance policy, we had discussed this when we were talking about salary. We discussed this when we were talking about PGBP. And now we will look at it from the point of view of income from other sources, right? So let's say, for example, the insurance was taken for the very important person in the enterprise, right? And salary part we have discussed, PGBP part we have discussed. From the point of view of income from other sources, when, let's say, for example, the person passes away and this particular Keyman insurance policy amount now comes into the hands of the family members, right? So when it comes into the hands of the family members, at that point of time, this is going to be treated as nothing but income from other sources. Why? Because the employee is no longer there. Next, we look at deductions under section 57. And over here, it is said that in case of family pension, we give a reduction of rupees 15,000 or up to 1/3 of the amount, whichever is lower. Next, in case of interest on compensation, there is 50% reduction given. Then there is reduction which is given on brokerage or commission to a broker or agent. Essentially, we are talking about any reasonable expenditure which is expended wholly and exclusively for the purpose of earning such income. So why did I spend a particular amount? I spent it because I needed to spend some amount to be able to earn. Now, when I'm spending that amount to be able to earn, that amount that I have spent, for that I get a deduction under section 57. Next is insurance premium, depreciation, repair and maintenance in case of composite rent. So in case of house property, we looked at deductions separately. But when you are giving out a particular property out on rent, and that too composite rent you are receiving, then you are going to get deductions for insurance premium, depreciation and repair and maintenance. Then we look at the case of lottery, gambling, betting, etc. In such cases, no deductions are allowed, right? So let's say, for example, you go and you buy yourself a 10 rupees ticket, and that 10 rupees ticket fetches you a lottery of, let's say, 10,000 rupees or 10 lakh rupees, right? And then you say that, well, I want deduction on that particular amount that I have spent. No, right? So you are not going to get any deduction on any amount whatsoever where lottery, gambling, betting, etc. is concerned. So you cannot even say that, well, I spent 10 rupees, right, for the purposes of earning that income, for the purposes of winning that lottery. So I should get a deduction. Nothing. So the moment we talk about any of these methods of earning wherein there is zero effort involved, at that point of time, there is no deduction whatsoever. So amounts which are not allowed as deduction: personal expenses are not allowed as deductions. Wealth tax is not allowed, direct tax is not allowed, interest or salary which is paid outside India without deducting the TDS, which is tax deducted at source, that is also not allowed as deduction. Any expenses or allowances with respect to winnings from lottery, gambling, crossword puzzles, card games, etc., what I just told you about, that is also not allowed. And then any unreasonable expense that you have, that is also not permitted. We now look at the case of CIT versus Rajendra Prasad Moody. So this is a case of 1978 decided by the Supreme Court. So in this case, there was this assessee who was there, and the assessees were basically two brothers, right? Now these two brothers, they had borrowed some money for the purposes of investment in shares. So they ended up paying some interest on the money that they had borrowed, right? But when they had borrowed that money for the purposes of investment in shares, with the intent that, they are probably going to get some dividend out of the purchase of those shares, it so happened that they did not end up receiving any dividend. So no dividend was received. And as a result of that, the assessees, they claimed for deduction. So when they made a claim for the deduction, the revenue obviously did not accept their claim. So they said that, well, what have we done? We have borrowed money. We have borrowed money for what? For the purposes of investing. So what was the purpose of borrowing that money? The purpose was to actually go and buy shares, and from that they thought that they were going to get dividend. But it so happened that they did not receive any dividend, right? So the court was faced with the question that should they get a deduction for the purposes of this expenditure that they have incurred. The court over here said that, well, we have to see whether or not the expenditure has been for a particular purpose of what? For the purpose of earning some money, right? Now, it does not matter. The court said that it does not mean that this purpose must necessarily be fulfilled, right? So if this purpose is not fulfilled, which over here was the case, so over here what were they trying to do? They were trying to get some money by way of dividend, but they did not. So probably the company did not do well, or just did not give out dividends that year. So their purpose of earning over here was not fulfilled. So the court said that simply because the purpose is not fulfilled, that does not mean that no deduction will be given. So the court said that this cannot happen, right? Because what is it that is required? Let's go back to the previous slides. And we say that if there is any reasonable expenditure which is expended wholly and exclusively for the purposes of earning such income, right? So what am I trying to do? I am trying to earn some income, as a result of which I have to spend some money. Now, when I'm spending that money for the purposes of earning, and just because I have not been able to earn, my purpose was to earn, but I did not end up earning. If I did not end up earning that, the court said it does not matter. We cannot say that you will not get a deduction. Why? Because you did not earn. You did not earn, right? But you had spent some amount for the purposes of earning, and therefore the court over here said that the assessee over here is liable to get the deduction, right? So over here the court had looked at section 37 clause 1 and they read it together with section 57 clause 3, right? And they said that there is a difference in the way the two are to be interpreted. So the court said that section 57 clause 3 does not require that the purpose needs to be fulfilled, right? And that is the key aspect that comes out from this particular provision, and as a result of that, the assessee over here was able to get a deduction. So with this, we conclude our different heads of income, and I hope you have understood that how is it that we start viewing any sort of income under different heads. We will first always start out with our head salary, move on to the next, which is income from house property, followed by PGBP, then we look at capital gains, and finally, if none of those income heads have been attracted by that particular type of income, then we will move on to this head of income from other sources. So while we finish off with our heads of income with this lecture, then we will start with a particular provision which is talking about clubbing of income. Where is it that we are going to club the income of somebody else together with your income, right? Now, when we look at all of these heads of income and take into account the facts and circumstances wherever they arise for the purposes of clubbing of income, then we will look at your total gross income, right? So without understanding these 5 heads and looking at the provisions of clubbing of income wherever they may be applicable, we cannot move on to understanding what would be the total gross income of any person, right? And therefore, we must ensure that when we are studying heads of income, we are also together with that taking into account the provisions of clubbing of income. And I hope with this, the lecture was clear to all of you. Thank you.
Hello, I am A.K. Sharma and I teach sociology in IIT Kanpur. I am attempting to answer a simple question, what is sociology? Now friends, one simple answer would be that sociology is a study of human behavior. And this study of human behavior has a history. Actually, due to growth of science, technology, and due to industrialization and economic development in the West, initially there was a hope that by application of science and technology, the face of this world can be changed to the advantage of mankind. But what was found or what was observed, that this did not happen. And despite economic development, urbanization, industrialization, surveys showed that poverty had increased, unemployment had increased, even health conditions became worse. And today you will be surprised to know that there was a time when death rate of urban areas was higher than the death rate of rural areas. Cities or the places of development industrialization and education and enlightenment became consumers of rural population. So, people started asking why is it so? And some philosophers, engineers, mathematicians who contributed to emergence of a discipline like sociology started thinking that perhaps we need a new subject in which we will apply the same tools and techniques which are being used by scientists, mathematicians, physicists, chemists, but we will study human behavior. In other words, we will try to discover if there are laws of human behavior, and by applying those laws perhaps in the future the condition of mankind can be improved. This is how sociology developed. Initially Auguste Comte called this social physics. He also used terms like social statics and social dynamics, the usual division of mathematics, and he believed that social statics will study relationship between different parts of society and social dynamics will study relationship between parts of society and total society, change in total society. Now, you may ask that if sociology is the study of human behavior, there are many other branches of social sciences which study human behavior, economics, anthropology, psychology, etc., etc. The difference between sociology and these disciplines is that while in these disciplines we study one specific aspect of human behavior, like economics will study production and distribution of wealth, psychology will study cognitive processes or mental models or personality, social psychology will study personality, anthropology will study culture. Now, somebody has to relate one aspect of human behavior with the other aspects or one social fact with the other. These are all social facts for us. And if somebody tries to link cognitive processes with economic conditions or urbanization or caste system or religion, or somebody tries to relate urbanization with human psyche, or somebody tries to correlate cultural context with economic behavior, then it becomes sociology. So, sociology combines different areas which are individually studied by different disciplines. And sociology also studies new questions which are not studied by any existing subject so far. So, like these days issues of waste disposal, entropy, environment, safety, urban places as new geomorphological systems come up, and we want to correlate one aspect of urbanization, say percentage of population living in urban areas, and risk, environmental risk, carbon dioxide, this emission, that emission. Now, which will be the first discipline to take interest in these things? Because sociology. So, sociology not only combines facts from different aspects of society, sociology also addresses new questions. And I can also say that one central feature of sociology is to explain individual behavior or individual psyche in terms of properties of larger society. In simple terms, if you imagine that there are two aspects of human behavior, individual and society, then while other disciplines like psychology are focusing more on individual, we study characteristics of individuals in terms of certain characteristics of larger society. This is what sociology does. Sociology is very useful for planners. Sociology is useful for answering new questions, as I said, which have not been answered by any existing discipline. And I would say that sociology is especially helpful for self enlightenment or for developing empathy, because sociology only tells you that there are no right or wrong answers of social issues. It is not physics, it is not mathematics, it does not have fixed answers to issues, because questions can be looked at from variety of perspectives. So, role of perspectives, thinking, interest, power, etc., also come up in answering social questions. And it is this aspect that something can be looked at from variety of perspective, that something can be looked at from the perspective of government, the same thing can be looked at entirely differently from the perspective of people or from the perspective of NGOs or from the perspective of experts. This realization, this takes us to self enlightenment and empathy. Thank you.